In 2006, Ben Bernanke assured Congress that the housing market was healthy and not a bubble. 2 years later, the global economy collapsed. Today, the yield curve, Wall Street's most trusted recession indicator, is flashing a signal even more extreme than before the 2008 crash. This inversion has lasted over 700 days, the deepest and most prolonged in history. And yet, the markets remain buoyant.
The dollar is falling. The empire is fading. But your voice is rising. Don't just watch history happen. Be part of it. Why'd have you checkmark subscribe to this channel for more fearless analysis from Richard Wolff and voices the mainstream media refuses to platform?
Consumer confidence high, and headlines strangely calm. That eerie quiet before the fall, it's playing out again. But this time, the warning isn't driven by subprime loans or a housing frenzy. It's structural, systemic, and far more dangerous. This isn't just another recession forecast. The data reveals a financial system pushed to its edge by decades of unchecked debt, now unraveling from within. Consumer spending is eroding. Delinquencies are rising, and commercial real estate is buckling. Symptoms of a deeper decay masked by short-term optimism. Historical parallels to 1929 and 2008 show the same pattern. Long periods of market euphoria followed by brutal collapse. The message is clear. This inversion isn't a fluke or anomaly. It's the clearest signal we have that a massive economic reset is not just possible, but likely. The most powerful warning sign in all of economics is blaring like a fire alarm, and the world is acting like it's a lullaby. The yield curve has inverted, not for a few days, not for a few months. It's been inverted for over 700 consecutive days. That's longer than it was before the Great Depression, longer than before the dot-com crash, longer than before the 2008 financial meltdown. And while the markets dance and the headlines spin tales of resilience, the clock is ticking toward a brutal and unavoidable economic reckoning. This isn't some obscure indicator used by a fringe economist in a dusty office. This is a yield curve, a consistent, historically proven predictor of every major U.S. recession in the past century. When short-term interest rates exceed long-term rates, it signals deep distress. It means investors believe short-term risk is higher than long-term prospects. That's not optimism. That's fear. And right now, that fear is deeper and more sustained than anything seen in modern financial history. We've been here before. In the late 1920s, the yield curve inverted just before the catastrophic crash of 1929. Same story before the 2000 dot-com implosion. Again before the subprime mortgage crisis in 2008. The pattern is clear, and right now, the pattern is screaming. But here's the twist. This time, the inversion is worse. More extreme, more prolonged, more systemic. This isn't about a bubble in housing or a single sector overheating. This is about the entire economic foundation crumbling under the weight of decades of cheap debt, financial engineering, and denial. The global economy today is built on a mountain of leverage: household debt, corporate bonds, government deficits, student loans. Never before has so much been borrowed by so many with so little margin for error. We're not talking about an external shock, a war, an oil embargo, or a pandemic. This is a slow, internal rot. The system is decaying from within, hollowed out by unsustainable promises and wishful thinking. And yet, despite this, the illusion of calm persists. Why? Because of recency bias. Because the last downturn didn't wipe us out. Because markets rebounded. Because AI is changing everything. Because unemployment is low. These narratives are dangerous. They mask reality. They create a sense of invincibility. But underneath that glossy exterior, consumer savings are vanishing. Delinquencies are rising. Full-time jobs are shrinking. Commercial real estate is collapsing. These are not signs of resilience. They're signs of imminent fracture. One of the most dangerous phases in the pre-crisis cycle is a whipsaw. It's when the yield curve starts to steepen again after a long inversion. Not because things are improving, but because markets misread the signal. Investors get pulled back in by false hope. Stocks rally. Optimism spikes. And then the final drop begins. We saw it in 2007. We saw it in 2000. We saw it before 1929. and the current environment fits the pattern to a terrifying degree. This is what makes today's situation uniquely alarming. The yield curve has been inverted for so long that it's not just a warning, it's a countdown. Every day that inversion continues, the pressure builds, the fragility deepens. And unlike past crises, we have fewer tools left. Interest rates are still high. Government debt is through the roof. Central banks are boxed in. The usual bailout playbook is worn thin. The truth is, the scale of imbalance in the global economy is staggering. Corporate debt has ballooned. Governments have spent beyond their means. Households are being squeezed by inflation, credit card debt, and stagnant wages. This isn't just a cyclical downer waiting to happen. It's a systemic failure in slow motion. And the yield curve is flashing red for anyone willing to look. But most people aren't looking, because the narratives are too comforting. We're told AI will boost productivity, that new technologies will save the day, that this time is different. But history laughs at those claims. Every major collapse was preceded by a story of exceptionalism, of new paradigms, of unshakable confidence. And every time that story was shattered by cold, economic reality. It's not just inversion itself. It's the depth and duration, over 700 days. That level of persistence indicates profound stress. Not a blip, not a misreading, but a genuine signal that something is fundamentally broken, that the structure of the economy can't bear the weight it's carrying, and that a correction is no longer a possibility. It's a certainty. And here's the most sobering part. There is no external shock to blame. No terrorist attack, no oil embargo, no black swan. What we're facing is the consequence of our own choices. Decades of financial engineering, of treating debt as a solution instead of a warning, of kicking the can down the road. Well, the road is ending, and the can is now a wrecking ball. The historical record is brutal in its consistency. Inversion happens. Optimism follows. Then collapse. Every single time. And during the optimistic phase, the lag between the signal and the crash, people mock the warnings. They call it fear-mongering. They quote the stock market. They point to tech innovations. But then the data starts to crack. The layoffs begin. The defaults rise. And suddenly, everyone remembers the yield curve. Too late. That's the stage we're in now. The denial phase, where strong narratives mask weak fundamentals, where the stock market is up but credit card debt is at all-time highs, where unemployment is low but full-time jobs are being replaced with part-time gigs, where inflation looks under control but grocery prices are still crushing families. It's the disconnect that always precedes disaster. This moment matters because the warning isn't hypothetical. It's mathematical. Bond markets don't lie. They're not emotional. They're not political. They're data-driven, long-term signals built on trillions of dollars of informed bets. And when those markets are this inverted for this long, they're not whispering. They're screaming. So why hasn't the crash happened yet? Because the system is coasting on fumes. Pandemic-era savings. Delayed defaults. Temporary measures. But those buffers are evaporating. Consumer savings are plummeting. Emergency assistance is long gone, and the safety net is threadbare. When the final trigger comes, whether it's a credit crunch, a debt ceiling crisis, or a default cascade, it won't be a slow decline. It'll be a cliff. The most dangerous response right now is magical thinking, believing that somehow, some way, this time will be different, that the economy can keep defying gravity forever. But gravity always wins, and the longer the fall is delayed, the harder the landing becomes. The yield curve doesn't offer guarantees, but it does offer warnings. And those warnings are not subtle. The track record is there. The signal is clear. The parallels to 1929 and 2008 aren't theoretical. They're real. And they're visible for anyone willing to look past the headlines and into the data. Right now, the biggest threat to your financial future isn't inflation, or interest rates, or market volatility. It's denial, the refusal to acknowledge what the bond market has been screaming for nearly 2 years. The belief that narrative can beat math, that storytelling can hold back economic gravity. But it can't. Not for long. This is a moment for vigilance, not complacency. For preparation, not euphoria. The yield curve has never cried wolf. And today, its signal is louder and longer than it has ever been. This is not a time to bet against history. It's a time to listen, to act, to be ready. If you found this breakdown valuable, make sure to like the video, drop a comment with your thoughts, and share this with someone who needs to hear it. Don't forget to subscribe for more straight talk and deep dives on what's really happening beneath the surface of the economy. Stay informed, stay sharp, and don't ignore the signal. Let's be clear, this isn't doom and gloom for the sake of drama. This is a reality laid bare by cold, hard numbers. The yield curve doesn't rely on opinion. It's not swayed by political talking points or feel-good headlines. It's a data-driven reflection of where investors believe the economy is headed. And when short-term yields skyrocket past long-term ones, that belief is crystal clear. Trouble is ahead. The inversion we're seeing today isn't just a flashing red light. It's a glaring spotlight on systemic failure. The depth of this inversion is without precedent. At one point, the difference between the 2-year and 10-year Treasury yields was the steepest negative spread ever recorded. That's not just concerning. That's economic panic embedded in the DNA of the bond market. And it's been this way, not for weeks or months, but for nearly 2 years straight. Compare that to past crises. Before the Great Depression, inversion was brief but deadly accurate. Before the dot-com bubble burst, inversion was shallow but effective. In 2006 and 2007, the yield curve flipped for about a year before the housing market collapse obliterated the global economy. Today's inversion is deeper, longer, and more dangerous. If past crises were earthquakes, this one is a supervolcano, silent for now, but building toward a catastrophic eruption. What's different this time isn't the signal. It's how aggressively we're ignoring it. In past cycles, there was at least some humility, some caution, some willingness to hedge bets. But in today's market, investors are partying like it's 1999. Tech stocks are surging. AI narratives are fueling euphoria. Unemployment is still low. People think they've outsmarted the curve. They haven't. They're just sleepwalking toward the edge of a cliff. That false sense of security, that's the trap. It always is. Because recessions don't start with a bang. They start with a shrug, with confidence, with glowing earnings reports and soft landing fantasies, with central banks pretending everything's under control. Then slowly, quietly, the dominoes fall. Consumer debt climbs. Defaults creep in. Job growth slows. Real estate markets start wobbling. Credit tightens. And before you know it, the economy is in free fall. While everyone asks, how did we not see this coming? The truth is, we did. We just chose not to believe it. One of the most chilling parts of this cycle is the lag. Historically, after the curve inverts, it takes 16 to 24 months of the recession to arrive. That's why people feel confident right now. It's been nearly 2 years, and still no crash. But this is textbook behavior. The lag is not a reprieve. It's a setup, a slow burn stage where optimism builds just enough to crush people when the crash finally hits. Think about 2007. The inversion happened, the signs were there, but the market kept rising. Home prices were still high. Banks were still lending. Everyone said the fundamentals were strong. Then collapse. Lehman, AIG, trillions wiped out in weeks. This isn't just a possibility. It's a proven pattern. And right now, that pattern is repeating itself in every major economic metric. Start with debt. Household debt is now at record levels. Credit card balances are surging. Delinquency rates are rising. Student loans are back on the books, and repayment is crushing millions of Americans. Corporate debt, also at historic highs. Many companies borrowed aggressively when rates were low, and now they're stuck refinancing at punishing costs. Government debt, off the charts. Deficits are ballooning. Interest payments on national debt are eating into everything else. And all of this is happening while inflation is still sticky, wages are barely keeping up, and central banks are stuck between a rock and a recession. This isn't sustainable. It never was. We're watching the slow implosion of an economic model built on cheap credit and perpetual growth. And that model is now reaching its endgame. But here's the scariest part. We don't have the tools to stop it this time. Back in 2008, the Fed slashed interest rates to zero and pumped trillions into the economy. That playbook is already worn thin. Rates are still high, and inflation has tied the Fed's hands. They can't slash rates without reigniting inflation. They can't raise rates without triggering a deeper recession. So they're stuck, paralyzed, watching the train approach with no way to change tracks. And governments? They're already buried in debt. Massive stimulus packages aren't politically or fiscally viable anymore. The cushion is gone. The safety net has holes. When the next shock hits, and it will hit, we'll have fewer options, less time, and more pain. We are teetering on the edge of systemic failure, not because of bad luck, but because of structural fragility, because we built an economy that only works under perfect conditions, one that relies on constant growth, low rates, high consumer spending, and endless confidence. But now, the conditions have changed, and the structure is cracking. The real economy is already signaling distress. Full-time employment is shrinking while part-time work surges. Delinquencies on auto loans and credit cards are rising fast. Commercial real estate, especially office space, is collapsing in value, with major cities seeing buildings go dark, loans default, and vacancies soar. Retailers are warning of weaker sales. Banks are tightening credit standards. And consumers are tapped out. That's not strength. That's exhaustion. The facade is crumbling, but the narrative is still being sold. That AI will save us. That the labor market is strong. That consumer confidence is resilient. But that narrative is starting to unravel. Because eventually, numbers beat words. Reality beats spin. And the market can't ignore fundamentals forever. That's where the real danger lies. In the illusion. In the belief that we can talk our way out of a mathematical inevitability. That because the crash hasn't happened yet, it won't happen at all. That mindset is not just naive. It's fatal. Because the yield curve is not a theory. It's not an opinion. It's a mechanism born from how markets price risk and time. When the curve inverts, it tells you one thing. The future is more dangerous than the present. That kind of inversion, especially at today's depth and duration, doesn't happen in a healthy economy. It happens when the smart money sees a storm coming and starts to prepare. So ask yourself, are you preparing? Because the markets sure aren't. The media isn't. Most people aren't. But the data is clear. The signs are screaming. And if you wait for the headlines to confirm it, it'll be too late. That's how denial works. That's how collapses catch people off guard. By the time the recession is official, the damage is already done. It's not about panic. It's about awareness. It's about being honest about where we are in the cycle. And right now, we're at the end of the calm before the storm phase. The final leg of denial before the consequences arrive. There's no soft landing waiting on the other side of this yield curve. There's no magic fix. Just a hard reset coming for an over-leveraged, overstretched, overconfident financial system. So what happens next? That depends on how we respond. The window for preparation is closing. Fast. This is the moment to assess your exposure. Protect your assets. Rethink your assumptions. And get real about what's coming. Don't fall for the headlines. Don't trust the rally. Don't dismiss the inversion. Because when history repeats, and it will, you'll want to be on the right side of the warning. No one in power wants to talk about this. Not the politicians banking on re-election. Not the Wall Street execs selling you the soft landing fantasy. Not the talking heads clinging to every Fed speech like gospel. Because if people actually understood what the yield curve is saying right now, if they actually grasped the magnitude of what's coming, confidence would collapse overnight. And once confidence goes, everything else follows. But here's the truth they won't say out loud. The economy is already deteriorating. Quietly, steadily, beneath the surface. They'll keep pointing to the stock market, like it's a heartbeat monitor. But markets are not the economy. The yield curve is. Think about it. If everything were fine, if the economy were really as strong as they claim, then why has the bond market, with trillions of dollars behind it, been screaming recession for 2 straight years? Why are long-term investors locking in lower yields than short-term ones. That doesn't happen in healthy economies. That only happens when the smart money sees pain ahead and starts preparing for it. But the average person, they're being gaslit by headlines. They're being told to keep spending, keep borrowing, keep pretending this house of cards is made of concrete. Meanwhile, household savings are evaporating. Credit cards are maxed out, and the cost of living is choking people in real time. You feel it at the grocery store, at the gas pump, on your mortgage statement. No spreadsheet can hide that reality. And the job market? Don't be fooled by the top-line numbers. Dig deeper. Full-time employment is dropping. Part-time and gig work are filling the gap. Layoffs in key sectors, tech, finance, logistics, are quietly accelerating. But no one wants to say the R word yet, because they know once the panic sets in, it's over. This is exactly how 2008 felt before the crash. Confidence, euphoria, disbelief that something so massive could actually fall apart. Until it did. Fast, brutal, unforgiving. And once again, the warning signs were ignored. Back then, it was subprime mortgages. Today, it's total system-wide leverage, consumer, corporate, and government debt all peaking together. A triple threat we've never faced at this scale. And don't forget the whipsaw, that deceptive pattern, where the yield curve starts to normalize right before everything falls apart. We're already seeing hints of it now. It's the trap that lures investors back in, gives them false confidence, just before the bottom drops out. It's happened before, and it's happening again. But this time, there's one crucial difference. We have no slack left in the system. No room to cut rates without stoking inflation. No political capital for more bailouts. No public tolerance for more moral hazard. We're staring down the barrel of a crisis with fewer tools than ever, and a public that's already exhausted. Think about how far we've stretched everything. Interest rates were near zero for over a decade. We printed trillions, pushed markets to record highs, encouraged corporations to take on record debt, to buy back their own stock. We created the illusion of prosperity by inflating everything, assets, wages, expectations, without addressing the real structural weaknesses underneath. Now all of that is unraveling. And the worst part? The narratives we're sold are making it worse. Every time we hear about AI or tech-driven growth or resilient consumers, it fuels the illusion that this cycle can be cheated, that fundamentals no longer matter, that history is irrelevant. But history always wins, and the yield curve is its messenger. Right now, the data is giving us the clearest warning in a generation. And it's not just saying a recession is coming. It's saying the system is breaking. Quietly, slowly, then suddenly. We're not preparing for a typical downturn. We're facing a reckoning with a debt-soaked system that no longer has a capacity to absorb shocks. So what does that mean for you? It means stop listening to the hype. Stop waiting for permission to prepare. When the yield curve is this deep, this long, and this persistent, the smart move is not to dismiss it. It's to act. Reevaluate your finances. Reduce unnecessary exposure. Get lean. Get liquid. Because when the hit comes, and it will come, it won't be gentle. By the time the media admits there's a crisis, it'll already be too late. That's the pattern. Every time. And right now, we are in that eerie silence before the storm. If this resonated with you, hit the like button. Share it with someone who still thinks the economy is bulletproof. Drop a comment with your take. We want to hear from you. And if you're not subscribed yet, now's the time. We'll keep cutting through the noise and telling the truth, while everyone else keeps pretending nothing's wrong. Stay awake. Stay prepared. The yield curve isn't wrong. And this time it's dead serious.